Welcome back to the monthly Alts Pulse. I'm Michael Sidgmore, co-founder and partner of Broadhaven Ventures and founder of the Alt Goes Mainstream podcast. Today, I'm here with iCapital co-founder and managing partner, Dan Boneh. Dan, welcome to the show.
Thanks for having me, Michael. Looking forward to the conversation.
Likewise. Well, I want to go back in time because you've really seen this from the beginning, and even your background before iCapital. Sometimes I think that the dots always connect and make sense afterwards. So I'd love to hear a bit about your background before.
Sure.
As a placement agent, starting a technology company, all of that, and then how that kind of has come to bear in terms of iCapital and now Marketplace.
Sure. Well, I think a lot of what has informed my career and some of the decisions I've made has been the timing around. I came out of undergrad in 1997, so started out on Wall Street as a bond trader, and as you know, back then the markets were pretty wild. They were actually very similar to how they are today. Certain tech companies were going up 100+% a year, and it felt odd to me, right? Like that whole dynamic, and it was completely contradictory to everything I had read from Warren Buffett and all the academic work I had done at undergrad around valuations and such. And so I established kind of a variant perception on the markets early on. And I think that's actually led me towards the private markets and informed a lot of the decisions that I've made throughout my career. That led me to starting a database company called Earnings.com, which was really was an event and earnings database aggregator, corporate events, upgrades, downgrades, splits, dividends, etc. And we made it available to semi-professional investors at a much lower price point than the other prevailing data services like Bloomberg, etc. And that was acquired by Thomson Reuters, 2001. Spent a handful of years there, managing a large team, and then I got into private equity right after that. Started working with Charlie Eaton at Eaton Partners, became a partner there, helping advising institutional and corporate pension plans, endowments, foundations, family offices on their alts selections. So that's really how I learned to love alternatives and really understand that, how they can benefit a portfolio.
Why did you move to private markets?
It was the experience of, truly like the gut-wrenching experience of 2000 and what I always describe as, and you hear other people say, that kind of lost decade of public market stock performance. Depending on your entry point to the markets, you can either think this is so easy and you can make just incredible returns, or if you start in the markets in 1999 and you might catch 6 months of a great market and then you have 10 years of a pretty crappy market. I think what that really informed me, I said, I don't want to have my own personal capital or my client's capital go through those types of volatility and gyration. And what I learned about private capital was that you can pick your diversification, you can pick your correlations, you can pick your outcomes much better than you can in the public markets, because the public markets are influenced by other people buying and selling, completely out of your control, where the private markets, you're making the buy decision, you're underwriting the manager, and then that manager is choosing the timing of the buy and the sell and the price they pay. Those are all tools that you simply don't have in the public markets.
I think that's a really interesting point about how to think about some of the reasons why investors would want to invest in private markets. And when you were in the placement agent world 10, 15 years ago, working with many of these funds, as well as larger institutional investors, do you think they all understood the merits of private markets to the extent that we do today?
Varying degrees of understanding, for sure, and it's similar to what you find in the private wealth channels today, which is why I think we'll probably talk a little bit about some of the innovation that's come to the market, why it's been so healthy, I think, and it's really led to broader adoption. When I was working on the institutional side, it was mostly consultant driven. So you had some very, very, intelligent people putting together programs, asset allocation, liability studies, et cetera, for these very large pools of capital. And so it was highly methodology driven. It was very, very tight allocation bands. You might have a 5% allocation to real estate, and you might further break that down between value add and opportunistic or debt. It was a highly programmatic way to invest. And I think we're getting to the point now in the private wealth channels where people are going to start to have those same tools, and there's enough product, high quality product, to now assemble a portfolio to create the kind of outcomes that people want, right? And you might ask, though, say, like, but again, like, index investing does work really well over long periods of time, right? In the public markets. And so why would you even bother with all that, right? Why would you bother with the subdocs and locking up your money for all of those time periods and such? And I think that probably the best answer to that is you should be in the public markets, index investing, for the vast majority of your money. And that's determined by you as an individual. Should that be 50% of your capital? Should it be 75%? Should it be 90%, depending on your age and your desired outcomes? But almost everybody should be thinking about ways to create income streams, maybe get more senior in the capital stack, be able to just have some amount of investment that is away from the gyrations and the volatility of the public markets, right? In the 27 or so years from 1997 to today, we've had 4 market drawdowns, 2 over 50%, 1 over 33%, and 1 over 25%, just in that time period of 27 years. 4 really debilitating drawdowns in that time period. And so if you think about it, if you're getting close to retirement and you have a 50% drawdown and you have 90% of your money in the S&P 500 or the NASDAQ, that's going to change your life in not a great way, right? Whereas if you had 20% in alternatives that was throwing off a 10% current yield or an 8% current yield, and you were actually getting that income on a monthly basis, which a lot of these products provide, monthly or quarterly distributions, you're going to have a much better outcome. You're going to be able to do the things you want to do in life because you have that diversification.
I think what you're getting at is the crux of something so core to alternatives, which is the question of liquidity versus illiquidity, right? There's a reason to have some level of liquidity, but the question is, and Apollo's Mark Rowan has talked about this a bunch, but how much liquidity does one need? And what is the definition of liquidity relative to illiquidity? How do you think about that concept? And you obviously worked with institutional investors who had maybe a different view than many individual investors have, or at least do have to some extent. But how do you think about the question of liquidity? And how is that changing given your purview, particularly around marketplaces, more investors? You're seeing more investors get into private markets, so they might be thinking about liquidity differently.
It's such I think a misunderstood concept, right? And you hear about it all the time, and people put such a premium on liquidity, right? And there's this unbelievable Morningstar study that talks about the same index returns we've been talking about, like generally considered 9% over long periods of time, 40, 50-year time periods, right? But then the average mutual fund within that time period might return 7.5%, right? And then the average investor in the average mutual fund had a net return of about 4%, right? And you say, well, that's less than half the 9% you just said the index return. And it's because of that liquidity, because of behavioral finance and the powerful emotions of fear and greed. And everybody is impacted by them. You could meet somebody who's been running a hedge fund for 30 years. Every morning when they go in and look at their P&L or their daily return, they have emotions of fear and greed. And so the importance or the value people place on liquidity is often winds up resulting in a less optimal outcome, because they use that liquidity to oftentimes make poor decisions. Whereas if you have a portion of your portfolio in stable, more senior assets, right, higher up in the capital stack, a current return, you can sleep at night. You can wake up happy in the morning because you're still going to get that return at the end of that 30-day period or that 90-day period. And you still have, more risk-oriented capital in the public markets, in tech stocks, big cap tech, et cetera. And you're still going to get those 30% up years. But when you have a really painful multi-year drawdown, you're still going to have that asset security and that current return. And so I personally think people should be more open to having a portion. Maybe it's 20% for some people, maybe it's 50% for a family office, but in private markets where you can pick your outcomes a bit more precisely.
Over the course of iCapital's history, how have you seen people's, when I say people, I mean the LP's perspective, particularly the wealth channel's view on a changing perspective on liquidity?
I would say that it hasn't changed as much as I would like it to, or as we would like it to. If you just look at how everyone is right now hanging on the Fed, right, and the impacts of monetary policy, and people are not thinking about long-term investments. They're not thinking about, I'm putting these dollars into the market and I have no intention of pulling them out for 20 years. It's not the way people think. People think by day, by quarter, and if they think the market's going to go down, they all rush, and pull money out, right? And it's nearly impossible to make the correct decision around that. So I think we all need to advance as investors in our understanding and our mitigation of those very powerful emotions that everybody faces. I would tell you that there are a lot of products now available in private markets that have some level of liquidity, right? We all talk about these like semi-liquid type products, and they're typically in a tender offer or interval fund format where it's either a board discretion liquidity or it's an obligation of the structure of the vehicle to provide liquidity. So if you're interested in getting some return on your investment and actually distributing that income, you can sign up and you can subscribe to an interval fund. And if you're saying, more interested in generating just pure return and you're willing to be patient, wait 10 or 12 years, you can probably generate a slightly higher return in a 3C7 fund or in a qualified purchaser vehicle. That would be a longer duration vehicle. But again, that's only appropriate for a certain qualification level.
Well, one of the things that's interesting about private markets, though, is, to your point, it may not be as accessible, or certainly hasn't been as accessible for many. There's challenges on both the GP and LP sides of accessing many of these funds. So I want to get to Marketplace, because in that respect, Marketplace can solve some of those issues. What caused you to, initially iCapital kind of had some elements of Marketplace. Mm-hmm. You've obviously arced back around to that because of so many of the features of Marketplace today and what the private wealth channel is demanding and what the GPs are demanding as well. But how have you thought about constructing Marketplace as a remedy for some of the things that we just discussed?
It's a great question, and Marketplace came out of just pure client demand. So we had a number of issuers on the fund sponsor side that wanted to list their products on iCapital. We have in excess of 100,000 financial advisors that work on the platform, and they wanted exposure to those advisors, which makes sense. But given that our distribution team and diligence team, they're somewhat bandwidth constrained how many opportunities they can take on and distribute. So the issuers were always asking and had more demand to list their funds on iCapital than we had the ability to distribute funds. On the flip side of that coin, on the buy side or on the private wealth side and the wealth manager side, they were always asking us, but I heard you work with XYZ manager and I don't see them on your distributed menu. Can I have access to everything that you do across the entire ecosystem? And so it really was an organic process working with all our clients on both sides of the table that we created Marketplace. And it's been wonderful because issuers are now able to use the operations and technology to get broader distribution with their own team, right? Through the technology and operational infrastructure that we've spent hundreds of millions of dollars building. And then on the flip side, the buyer side, right, the wealth managers now see everything, hundreds of funds and offerings, different structures, different qualification levels, all in one repository, all in one unified interface.
So that brings me to the question, something that Nick, another co-founder of iCapital, his famous line is private equity is sold, not bought. How much did that factor into your mind as a concern potentially as you were building Marketplace? Like, okay, we could put these funds on Marketplace, but if private equity is still sold, not bought, will people buy?
Yeah, I have disliked that saying from the very first day, but it is true, and it still is largely true. I think the reason it's true is because it takes time to understand these different structures and strategies. It takes time for advisors. It takes time for the home office and the CIO. And one of the things that we're seeing, and this is this is the last year or two, maybe 3 years that we're seeing this evolution of the market, is that the evergreen funds and the perpetually available funds have really emerged. And they're high quality vehicles. They have much lower fees than they used to have. And they're run by the top quality managers in the world, right? Top decile, top quartile managers all have these products now. And so the investor and the advisor now have the ability to learn a story one time and then make it available to all of their clients for years to come. And that's truly changed the dynamic of alts are sold, not bought, because today an advisor can get the pitch. They can ask a whole bunch of very difficult diligence questions. They can review the diligence materials. They can plug it into a tool like Architect on iCapital or something. They can understand the risk profile and the factor-based analysis. and then they can bring it to all of their clients. Look at their own individual portfolio, how this product might impact, whether have a positive or negative impact on their current existing portfolio to, again, achieve the outcomes they want. But then they can just keep selling that same fund. And so investors, when they have more liquidity, or maybe they have their children's accounts or relatives accounts, they want to bring them into those, they can now buy that same fund that they own with their relatives' capital or their children's capital. And so I think we're at an inflection point in the market where alts are going to become more bought. I'm not sure they're going to become bought broadly, like just generally speaking, but I think we now have the ability and we have the systems and the technology for them to be much more like an ETF or an index fund exposure.
Brings up a really interesting question for managers of different size and scale. So to date, it's mostly been the larger managers that have been able to work with the private wealth channel for a number of reasons. They have the size, the resources, the scale, the teams, the number of people that can cover the wealth channel properly. Marketplace may change that a bit. Does that mean smaller funds will start to think about evergreen structures based on what you're saying? Because they may not need to have the size and scale of a Blackstone and the private wealth solutions team to be able to work with the wealth channel, because they can leverage a platform like Marketplace. But then also, if they have an evergreen structure, that the sales motion ends up being different.
Yes, it does. There are still some material upfront costs for setting up an evergreen structure, and you have to have the right strategy behind it, right? You can't do an evergreen around everything, right? Particularly if it's in the interval format, because you have to provide a certain amount of liquidity, right, on a quarterly basis. But for the right structure and the right strategy, an evergreen fund can make a lot of sense. And there are firms like iCapital and others that can help you structure those vehicles and really kind of show you the way through. There's also, though, when you think about, there's still a lot of strategies that are higher returning strategies that won't fit into that kind of a structure. And so I think there's going to be, plenty of runway for your typical, private equity, either whether it's a master feeder structure or directs into 3C7 vehicles. There's no question about it. The evergreen structure is an amazing evolution. It's been adopted quite broadly. And I think it's probably, to some extent, managers are learning that capital is perpetual. So not only do the investors like it because they learn the story, they understand it, they're comfortable with it, right? But the managers like it because they can rely on the capital, and it becomes more of a perpetual vehicle versus having to go out to the market every 3 years, or some of them are almost like constantly marketing, but they're marketing different funds, right? I think it's a more efficient structure for the market, but again, it doesn't work for every structure and every strategy.
Have you found that on Marketplace, the most popular funds have tended to be the evergreen structures?
There's no question that we're starting to see larger dollars going into those types of vehicles. There are highly sophisticated advisors and investors who don't buy evergreen funds, and they sort of specialize their practice around picking top decile, top quartile private equity funds, and I think they'll continue to do that. They're having great results with that, right? But for your first investment, or for if you want to be in a more diversified pool of capital and you want to have some vintage year duration and some seasoning on some of those earlier investments, an evergreen fund is great. I guess I'd make one other point in this area, which is model portfolios. We've obviously covered that quite a bit, and there's a lot of work done on it. Model portfolios give people like almost the true easy button to get a turnkey alts allocation day one. It could be around income strategy, it could be a balanced portfolio, it could be a growth portfolio. And you not only get diversification within the evergreen vehicle that's in the model, but you get diversification at the manager level as well, right? So you might have 4, 5, 6, 7 at the most, probably, top tier managers that then have a diversified fund. And so you're winding up with a vintage year diversification, deal level diversification, structure diversification, and sponsor diversification all in one investment, in one ticket.
It feels like we've gone through this evolution in private markets. First, it was just about how do you provide access to the wealth channel. Obviously needed a combination of technology, education, the ability to provide investors with that access. That's happened. You now have opened that up with something like Marketplace to provide easier access for the wealth channel, but also make it easier for GPs to raise capital from the wealth channel in a more continuous way. Mm-hmm. Now you talk about technology. What has technology like Architect helping people construct portfolios, or I think you're referring to IMAP, the creation of multi-manager structures or evergreen vehicles effectively all in one portfolio. How much has technology impacted the ability for Marketplace to become more successful than it may have been a few years ago or even today going into the future?
When we started the company, I had a tech background, and many of our early employees did, and the idea was that technology was going to be an edge, right? What I didn't realize at that point in time was that technology was going to become the business, right? It's truly a tech business today, because it's not just about picking the best managers and creating an electronic subdoc and creating online performance reporting. We were doing that stuff 12 years ago. What we're doing today is wiring up the entire ecosystem. So the fund administrators, the transfer agents, the custodians, the third-party performance reporting platforms, customized reporting that an RIA wealth manager wants to see on their dashboard, internal workflow tools. We have 500 plus software engineers at iCapital building this technology, and because so many more people are interested in tapping into the private wealth market, it's not as much about trying to get that great allocation and that top decile manager. Today it's really about making the transparency and the purchase decision as easy as possible, and creating the educational backdrop for people to make more informed decisions. And so technology runs through all of those components, right? It runs through the diligence process, the pre-purchase, the purchase process, and the life cycle ownership for the next 10, 12, 15 years that you own the product.
What's fascinating about what you just said is tying that back into your prior background and what you were saying about the placement agent business. Is this seems like it's really changing the way that fundraising will occur. Talk to me about that in the context, like, does this truly change the way that firms raise capital?
It is for sure, and not for all of them, right? There are middle market buyout firms and small venture firms that produce fantastic returns. All their funds are oversubscribed by institutions, and for them, maybe they'll let in a family office or an RA or something, but it's not their business, right? It's not core to their survival. There are other firms that have really grown quite large, and they've already working with just about all the major institutional allocators, and to get growth, they really have to come to the private wealth channel, right? And so, some of the larger, more established managers are finding themselves in that category. If they want to find growth, they have to create really innovative structures. They have to create LP-friendly fee structures. They have to educate and communicate incredibly well with the marketplace. And you're seeing these firms do this, right? And so iCapital can help anybody do that from the operations and technology standpoint. But if you want to really develop a brand and you want to be long-term in the private wealth market, there is an investment, and you do have to put the right people out in the field to be able to help educate the market for sure.
What have you learned thus far from the managers who've been most successful on Marketplace in terms of capital raise, getting the right exposure? What have they done well that others maybe haven't?
There's always been a saying, even on the institutional side, sort of stay within your lane, kind of like do what you say you're going to do. And I think the best managers that have found the most success, they have not overpromised, right? They obviously try and over-deliver, but they also just provide the outcome that they endeavored to provide, right? So if an investor is going to build a portfolio looking for diversification, looking for income, looking for growth maybe, right? You have to stick to the mandate. You have to do what you said you were going to do. And those are the firms that are finding the most success. And I think if the strategy is too complicated and you can't explain it, on the back of an envelope or in a 5-minute conversation, it might be better off in an institutional context or in a 3C7 type, QP fund. In the accredited investor world, and where that kind of first investor dollar is going to go into alternatives, it has to be a strategy that people can understand, that the CIO can get behind, the advisors can understand, and then ultimately the investors can understand, because it's a multi-part buy decision, right? iCapital does their diligence, that we bring it to the market, the CIO has to get comfortable, the advisors have to get comfortable, the end investors have to get comfortable. So if it's a super complicated strategy, or you've strategy drift or you didn't do what you said you were going to do in the prior fund, it makes it a really tough sell.
So what's it going to take for funds to go from sold to bought to truly private markets is going to be bought instead of sold?
It took a lot of product innovation. I think there will be a lot more product innovation. I think education is paramount and continues to be. Many are investing heavily in that space, ourselves included, obviously. But it may take a market event. That could be a catalyst, right? It may take a market event like the decade from 2000 to 2010, where you really had 0% returns on an annualized basis and a total return basis, right? That people say, maybe I don't want 100% of my money locked up in the S&P 500, or not locked up, right? Just in the S&P 500. Like the Magnificent Seven generated 66% of the return in the entire S&P 500 in 2023, right? If those, I'm not even saying or suggesting for a minute that they're not going to be great companies for the future, but if they don't continue at that same pace of return, you might have a sideways market for a period of time, right? One of my favorite indicators on valuation is the Buffett indicator, right? Which is just total US stock market valuation divided by US GDP, right? We're about 190% right now. There's only been 3 other times since about 1970 that we've been close to 200%. And all 3 of those times led to about a decade of underperformance. So the reason why I like that one metric is because people say, well, yeah, but what about AI? What about technology? What about innovation? What about greater productivity? That's all captured in GDP, right? You're capturing that. So what you're doing is you're actually looking at pure valuation and productivity and output. And you're saying, are we out of line? Are we 2 standard deviations from where we should be? Are we 1 standard deviation? Are we right in line? And so those are the types of metrics. And maybe it takes a pullback there, right? Or just a period of flat returns and people say, God, I wouldn't mind getting an 8% current yield right now on a direct lending fund that's senior secured, right? It's actually a more senior credit, less risk, higher in the capital stack than the stocks that I'm buying, right? And so maybe it's events like that.
Yeah, I think you're bringing up a great point, and it's a great way to kind of bring this whole conversation full circle, is that we're really in a new world order for investing. And what's fascinating about that is if you think about last 10 years are very different than probably what the next 10 years are going to be in part because interest rates and part because a lot of the things you're saying. But it also feels like, based on what you've said about private markets, we've reached kind of the next phase of what private markets are going to look like, in part because of innovations like Marketplace and how people are thinking about private markets. So this was a fantastic conversation. Thanks for coming on the show, Dan.
Enjoyed it, Michael. Thank you.
Awesome. Well, thanks everyone for watching this episode. I'm Michael Sidgmore. See you next time on the Monthly Alts Pulse.